Hi guys, thanks for tuning in. My name is Colin Bonnett and I'm a financial advisor here at IHT Wealth Management in Chicago. Point of these videos, right, is I'm a young financial advisor in the industry, and just being in that position, I get a lot of questions from friends, families, other peers that I'm just asking about some basic financial questions, things you come across early in your career that maybe you're not quite familiar with because you don't have the experience, right? So, just for example, a lot of times I get, how much should I contribute to my 401k? Should I choose Roth versus traditional 401k? Just questions like that. A lot of student loan questions, everyday items that you and I come across in our everyday lives. So I wanted to kind of put together a couple videos that address some of these topics. I notice sometimes people are hesitant to ask on these types of questions, so I want to encourage that, right? Ask questions, be proactive, go out and find resources that'll help you answer these questions, because at the end of the day, saving for retirement, family planning, things like that, it starts day one. It starts the moment you start that first job. So they're important, and you need to know these types of things. So to get started, I'd like to talk about one of the main three asset classes. So I mentioned 401k plans. A lot of the times they offer some type of blend of stocks, bonds, and then a mutual fund or ETF option. So for this video, I'm just going to focus on stocks, bonds, mutual funds, and ETFs. There's a lot more information. There's a little bit more, they're a little more complicated. So stocks seems to be the basic things that everybody kind of knows, has some sort of familiarity with. So stocks, what are they? What exactly is stock? Stock represents ownership in a company. So, for example, let's say I have this made-up company, Colin Bonnett Incorporated, right? And I have 100 shares outstanding, and you own one of those shares. So what that means is you own 1% of my company. What does that mean, right? It comes with a number of what's called rights. So just for example, number one would be the right to receive dividends. And I'll elaborate a little bit more on what that means in a minute. There's another right to maintain proportionate ownership. And so what that means is if you're a 1% owner, you have the right to continue to be a 1% owner. And again, we'll tackle a little bit more of that information in later videos, but that's kind of the gist of what that means to own stock. So lastly, it would be, why do you buy stock? Now, people invest in stock for a wide variety of reasons, and you could make an argument for plenty of them, right? I want to focus on kind of the main two, especially early on, that you come across. So reason number one would be what's called capital appreciation. Now, that's really just a fancy way of saying growth in value, right? So to use that same example of Colin Bonnett Incorporated, that one share, let's say, I'm some tech company and I have some groundbreaking technology that's going to change the way we look at technology. You see that and you say you're poised for tremendous growth, and you want a piece of that growth. You would buy that one share, and let's say at the time you buy it for $1. And the goal would be, over the course of 5-10 years, whenever you decide you want to sell your shares, is let's say you can sell that share for $10, $20, $50, $100, right? And that's where you add your value, and that's where you make your money. Everybody's heard the term, buy low, sell high, and when we're talking about growth stocks, that's where that really comes into play. On to the second reason. It's pretty much the complete opposite. So let's say my company, rather than a tech company, I'm an electric company, right? Everybody pays their electrical bill. I don't know about you, but that's something important to me. So I'm an electrical company. I collect these monthly electrical payments. Colin Bonnett Incorporated, we take our cut, and then with the money left over, we are obligated to pass that on to shareholders. And that's through the form of dividends that I mentioned earlier. So I would pay you a quarterly payment. Let's just say, easy numbers, $1 per share. So when I pay that out, if you own one share, you get $1. If you own 10 shares, you get $10, and so on. That's kind of the gist of the basics of dividends, right? And there's some other nuances, and again, as everything in this industry, if you really want to dive deep, it can get complicated, but that's kind of the surface, right? And like I said, there's a number of other reasons, and you can turn on the TV, you'll hear people make cases for all sorts of reasons, but capital appreciation and to generate income are kind of those two main reasons that people invest in stocks. So that's it. I want to keep these videos kind of short and to the point, so that's kind of it for now on stocks. Like I said, I'll talk a little bit more on bonds, mutual funds, ETFs, the difference between some different types of accounts and what you can do with it. So, but at the end of the day, I want to hear from you guys. I want these videos to cater to the public, and I want to make sure they're relevant to the questions that you guys have. So if you have any questions, any comments, any topics that you would like me to address, I'd be more than happy to. Leave them in the comments below, and thanks again for tuning in.